Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025 May-June Paper 1-2. This is Paper 1, which consists of 30 multiple choice questions, and the total time limit for the paper is 1 hour. And in this video as well, we'll be attempting to solve this entire paper under 1 hour. So without any further delay, let's get started. For the first question, Ahmed and Betty are in partnership. They plan to convert the business from a partnership to a limited company. Ahmed and Betty will now be shareholders. What is the benefit to Ahmed and Betty as shareholders? The first one states that disputes between them will be resolved in the annual general meeting. So, annual general meeting is not really set to figure out or sort out any sort of dispute between or among the shareholders. Annual general meeting is set in order to talk about the agendas of the business, such as how much dividend should be proposed as the final dividend and such. So option A is not the correct one. The second one is their personal assets are protected. That is true because as partners, they have unlimited liability. So they will have to use their personal assets in order to cover the debts of the partnership business. But now as shareholders, they will not have to do any such thing because they will now have limited liability, which means that their personal assets are protected. So the correct answer will be option B. Let's take a look at the remaining options as well. Their personal finances are not separate from those of the company. That is not true because whenever there is a limited company, it has a separate legal identity as well. So their personal finances will definitely be separate from those of the company. Then the fourth one is the value of their shares will increase. So the value of their shares within the limited company will not increase. The price might increase within the secondary market, where the market price per share might be higher than what they invested to set up the limited company. So option D will also be incorrect in this case. That's all for the first one. Let's move towards the second one. What is the correct double entry to record goods taken for own use by the owner of a business? So goods taken for own use just refers to drawings. And as per our accounting principle, all of our drawings should be recorded on the debit side. So on the debit side, we need drawings, which is given by option A and option B. Now, in this case, we are talking about goods taken for own use. And whenever the owner takes goods from the business for their personal use, now we need to reduce the value of purchases for the business because whatever goods are being taken, this now does not belong to purchases. So what we need to do is we need to reduce the value of the purchases. And remember, as per our accounting principles, purchases are always recorded on the debit side. Now, in order to decrease it, we should be recording this on the opposite side. So in this case, we want purchases on the credit side, which is given by option B. So the correct answer is B. That is all for the second one. Let's move towards the third one. Which accounting concepts are applied when depreciating non-current assets? The very first one is consistency concept. That is true because we have multiple methods of depreciating non-current assets. We can use straight line method, we can use reducing balance method, or we can use revaluation method as well. And we need to be consistent with what accounting concepts we apply. So if we are applying straight line method in year 1, we need to be consistent with the policy. We need to apply straight line method in year 2, 3, 4, and so on as well. So we apply the consistency concept. Second one is matching or accruals concept. We apply this one as well because matching concept states that whatever expenses have been incurred during the year should be matched with the revenue of that particular period. And by depreciating non-current assets, we do the exact same thing. So whatever expenses have been incurred by utilizing the non-current assets, we basically match it to the revenue for that year. So 2 is included as well. Then third one is objectivity. Remember that there is no such accounting concept called objectivity within our syllabus. So this is automatically untrue. And the fourth one is prudence concept. This is also correct because prudence states that assets and profits should not be overstated. And by including depreciation as part of our expenses, we are not overstating our profits. And by subtracting the accumulated depreciation from the cost and figuring out the net book value, we are not overstating the value of our assets. So the correct one should include 1, 2, and 4, which is given by option C. That is all for the third question. Let's move towards the next one. For the fourth one, which account balance will be in the credit column of a trial balance? Remember that within the debit column of our trial balance, we include all of our assets, expenses, and drawings. And within the credit column, we include all of our liabilities, incomes, and capitals. So we need one of these three. So the first one is carriage inwards, which is part of our expenses. This will be recorded on the debit side. So this will be incorrect. Carriage outwards is also part of the expenses, which means that it will go on the debit side as well. So this is incorrect. Purchases returns is part of our income because purchases is an expense, and whenever there is purchases returns, we will be returning the goods to the supplier and we will be receiving refund for it. So this is part of our income, which will be recorded on the credit side. So C will be the correct answer in this case. Let's take a look at the last option as well. We have sales returns. Sales returns is source of our expenses because in this case, the customer will return the goods to us and we have to make a refund. So this is also incorrect. That is all for the fourth question. Let's move towards the next one. The financial statements were prepared using the following details. So purchase cost of machinery. This included 450 for repairs to the machinery. This should not have been included because repairs is our revenue expenditure, whereas the purchase cost is our capital expenditure. Then we have lighting and heating, which is part of the revenue expenditure. And this included 250 for wiring in the factory extension. So whatever work goes on towards extending the factory will have to be included as part of our capital expenditure. Then we have carriage inwards, which is our revenue expenditure. Then included 45 for delivery of the new machinery. Remember that any delivery cost for our non-current asset will be included as part of our capital expenses. And remember that capital expenses are all of our non-recurring expenses, whereas revenue expenses are all of our recurring expenses. And capital expenditure will always be included as part of the cost of the non-current asset, whereas revenue expenditure will have to be shown as expenses for the year within our statement of profit or loss. Now, what will be the amount of the decrease in non-current assets when capital and revenue items are treated correctly, ignoring depreciation? So we need to figure out the impact within our non-current assets, which means that we are taking a look at the impact within our capital expenditure. So the very first one is that within our capital expenditure, we include 450 that belongs to revenue expenditure. So our capital expenditure will have to be reduced by 450. Then for the second one, our capital expenditure is being included within the revenue expenditure. So now we need to include it within the capital expenditure. We have to add the 250. And for the third one, we are including 45, which is part of the capital expenditure under revenue expenditure. So again, this should be included within the capital expenditure. Now the total decrement will be minus 450 plus 250 plus 45, which results in negative 155. And in this case, the question clearly states what will be the amount of the decrease. Since this is a negative, this represents a decrease, and the amount is of 155, which is given by option A. That is all for the fifth question. Let's move towards the next one. What is the purpose of depreciating a non-current asset? So we're basically dividing the cost of non-current asset over its useful life. That should be our answer. And it is clearly given within the first option to allocate its cost over its useful life. Let's take a look at the remaining options as well to reflect its market value. So by depreciating a non-current asset, we will only be able to figure out the net book value or the carrying amount, not the market value. So this is incorrect. To reflect its replacement cost. Again, we do not know what the replacement cost for the non-current asset will be, and it cannot be figured out by depreciating a non-current asset. So this is also incorrect. Then to reserve funds for its future replacement. Always remember that depreciation is a non-cash expense. We are not spending any cash over it. We are just allocating the total cost of the non-current asset over the useful life and including that within our statement of profit or loss. So there is no reserving of funds. This is incorrect. That is all for the sixth question. Let's move towards the next one. The non-current assets of a business are shown in the table. We have the opening balances as well as the closing balances for our costs, accumulated depreciation, as well as the carrying value. Now, during the year, non-current assets costing 110,000 were bought, and non-current assets with a carrying value of 20,000 were sold. What was the depreciation charge for the year? Okay, in this case, we need to figure out the depreciation charge for the year, but no depreciation policy is provided. In such cases, you always need to utilize your schedule of non-current asset. And for the schedule of non-current asset, we use all of our carrying value, which is the net book value. So we start with the opening net book value, then we add the purchase cost, the cost of the new non-current asset that was purchased during the year. Then we subtract the disposal, and for disposal, we subtract the disposed non-current assets net book value. Then if there is any revaluation upwards, we need to add it. If there is revaluation downwards, we need to subtract it. Then we subtract the depreciation charge for the year, which will give us our closing balance of the net book value. So let's create an equation using the same format. Our opening net book value is 225,000. Then for purchase, we were told that non-current assets costing 110,000 were bought. So we need to add the 110,000. Then we need to subtract the disposed assets net book value, and again in this case, non-current assets with a carrying value of 20,000 were sold. This is the net book value. So we need to subtract the 20,000. Then no information regarding revaluation is provided, so we can directly subtract the depreciation. And this should be equal to the closing net book value, which is 240,000. Now we just need to solve for depreciation. That will be 225,000 plus 110,000 minus 20,000 minus 240,000. This results in the value of 75,000. So this is the answer we're looking for, which is given by option D. That is all for the 7th question. Let's move towards the next one. After the profit for the year was calculated, the following errors were discovered. Okay, what will be the effect on the profit for the year after correcting these errors? Okay, so let's consider our draft profit. And we will adjust all of these errors to the draft profit now. So for the first one, discount allowed of 550 was recorded as discount received. So this can be split into two different errors. Firstly, the discount allowed was understated. Whenever something is understated, we have to add it. And we are trying to calculate its impact on the profit for the year. Discount allowed is an expense which will reduce the profit for the year. So it's a plus and a minus, which results in minus. So we need to subtract 550 in order to correct the error for discount allowed. And now for discount received, it was overstated. So whenever something is overstated, we need to subtract it. And in this case, we are talking about discount received. Discount received is an income which will be added while calculating the profit. So negative and a positive, which again results in a negative. So we again need to subtract 550 to correct the error for the discount received. Now for the second one, rental income of 3,500 was recorded as an expense. Okay, so expense is overstated and income is understated. So again, this can be split into two different errors. So for the first one, rental income, that is understated. Whenever something is understated, we have to add it. And in this case, we're talking about income, which will be added when calculating the profit. So two positives will again result in a positive, which means that we have to add 3,500 in order to rectify the error related to rental income understated. Now it was also recorded as an expense. So expense was overstated. Whenever something is overstated, we need to subtract it. And in this case, we're talking about expense, which will again be subtracted while calculating the profit. So we have two negatives, which again result in a positive. So we again need to add the 3,500 in order to rectify the mistake for the expense. Now for the third one, wages of 4,500 were recorded as 5,400. So in this case, we can see that the amount was overstated. And the overstated figure will just be the difference between the two values. So 5,400 minus 4,500, which results in 900. Now, if something is overstated, we have to subtract it. And in this case, we're talking about wages, which is also part of the expenses, which will be subtracted while calculating the profit. So we have two negatives, which results in a positive. So we have to add the 900 in order to rectify the error related to wages. Now, this will just be draft profit. Now, minus 550 minus 550 plus 3,500 plus 3,500 plus 900, which results in plus 6,800. So the effect is that after correcting all these errors, our previous profit will now increase by 6,800. So that is the answer we're looking for, which is given by option D. That is all for the 8th question. Let's move towards the next one. A business's suspense account appears as follows. We have the opening balance, sales, and discount allowed. Which statements are correct? Okay, total debits had been 100 less than total credits in the trial balance. So in this case, we can see that the opening balance of 100 is on the credit side. So what this means is that within our trial balance, the credit side is lower than the debit side by the amount of 100. And first statement states that total debits had been 100 less. This is incorrect because in this case, the credit side is lower by 100. So 1 is incorrect. For the second one, the sales account had been overcast by 50. Okay, so the correcting journal entry for this one is since sales appears on the credit side in this case, suspense is on the credit side within the journal entry. Then sales is on the debit side. Remember that sales is a source of income, so it will usually be recorded on the credit side. But if it is being recorded on the debit side, it means that we are removing the sales. And we remove sales whenever sales has been overstated or overcast. And that is exactly what's given by the second statement. The sales account had been overcast by 50. That is the amount. So the second statement is correct. Then the third one, the discount allowed account had been overcast by 150. In this case, discount allowed appears on the debit side, which means that within the correcting journal entry, suspense appears on the debit side. So the discount allowed is on the credit side. Remember that discount allowed is our expense, and expense is usually recorded on the debit side, but in this case we are recording it on the credit side. We record it on the opposite side whenever there has been some overstatement. And in this case, the third statement gives the same information. The discount allowed had been overcast by 150. That is the amount we've recorded here as well. So the third statement is also correct. So we need 2 and 3, which is given by option C. That's all for the ninth question. Let's move towards the next one. Why does a business prepare a bank reconciliation statement? So bank reconciliation statement is prepared so that we can adjust all of our unpresented checks, uncredited deposits, and we can adjust all of the items that is missing from our cash book as well. So basically, whatever items cause the difference between our cash book balance and the bank statement balance, those will be adjusted while preparing a bank reconciliation statement. Now, the first one is to determine the cash in hand balance. That is incorrect. We just need to explain the difference, which is exactly given by the second option, to explain the difference between the cash book balance and the bank statement balance, which will be caused by all of the unpresented checks, uncredited deposits, as well as all of the items that are missing from the cash book but have already been appeared within our bank statement. Let's take a look at the remaining options as well. To identify dishonored checks from trade payables. So dishonored checks will not be identified by preparing a bank reconciliation statement. This is incorrect. And to prepare a statement of profit or loss. Okay, remember that by preparing bank reconciliation statement, we will figure out the total value within our cash at bank, which does not appear within the statement of profit or loss. So this is clearly incorrect. That is all for the 10th question. Let's move towards the next one. A debit balance of 2600 was shown for the bank in the cash book of a business at the end of the month. The bank statement included bank charges of 1200 and interest received of 500, both of which had not been entered in the cash book. So we need to enter these two within our cash book. The bank column of the cash book had been overcast by 200. The cash book included a payment of 800, which had not yet appeared on the bank statement. What was the credit balance shown on the bank statement at the end of the month? Okay, so we need the value that was shown within the bank statement before correcting all of these errors. And in this case, so the first thing we have to do in this case is correct our cash book. So we have cash book. We have been given the opening balance as well. The debit balance of 2600 was shown for the bank in the cash book of a business at the end of the month. So that's 2600. Then bank statement included bank charges of 1200 and interest received of 500. So this one is expense, this one is our income. And within our cash book, all of the incomes will be recorded on the debit side and all of the expenses will be recorded on the credit side, both of which had not been entered in the cash book. So we now need to enter it. The expense of 1200 on the credit side, the income of 500 on the debit side. Then bank column of the cash book had been overcast by 200. So it means that 200 was overstated as our income. So we need to remove 200 from the income side. For that, we just need to enter 200 on the opposite side. So it will cancel the incorrect amount or the overstated amount. Now, the first thing we need to do is figure out the closing balance right here. For that, we need the total from our debit side. So that's 2600 plus 500, which results in 3100. Then the closing balance will be 3100 minus 1200 minus 200, which results in 1700. Now we need to prepare the bank reconciliation statement. So what we need to do is figure out the balance as per the bank statement. This is what we're trying to figure out. And after this, we make adjustment for uncredited deposits and unpresented checks. So we add all of our uncredited deposits, subtract all of the unpresented checks. Then this would give us the balance as per updated cash book, which we just figured out. That's 1700. And this is a positive amount because this 1700 will go towards the debit side as part of the opening balance, which is on the income side. So this is a positive value. Now, the cash book included a payment of 800, which has not yet appeared on the bank statement. So, we've already made the payment, but it is yet to be presented within our bank. So, this will be unpresented check. So, we need to subtract the 800 right here. And there is no information regarding uncredited deposits. So, now we can create an equation. So, this is just x minus 800 should be equal to 1700. So, x should be equal to 1700 plus 800, which results in 2500. So that will be the balance as per the bank statement, which is exactly what we have been asked to calculate. What was the credit balance shown on the bank statement at the end of the month? That's 2500, which is given by option C. That's all for the 11th question. Let's move towards the next one. Why is the sales ledger control account used? The very first one is to control discounts received. So sales ledger control account helps us calculate the total value of trade receivables. This is not a way to control discounts received. We only enter the discounts received amount in order to calculate the closing balance of the trade receivable. So 1 is incorrect. To ensure credit customers pay promptly. Again, we are only trying to calculate the trade receivables value. By preparing sales ledger control account, there is no guarantee that the customers will pay us back quickly. So the second statement is also incorrect. To provide a trial balance figure for trade receivables, that is the main purpose of sales ledger control account. It is basically the account for trade receivables. So 3 is correct. Now, answer should include 3 only, which is given by option D. That is all for the 12th question. Let's move towards the next one. A bookkeeper is given the task of reconciling the sales ledger control account with balances in the sales ledger at the end of each month. The sales ledger control account showed a debit balance of 26,000 before the bookkeeper discovered the following. What is the correct figure for trade receivables at the end of the month? So we can calculate the correct figure for trade receivables by simply preparing the sales ledger control account. Remember that sales ledger control account is trade receivables account, which is an asset account. So whatever increases the value of trade receivables will be recorded on the debit side, and whatever decreases the value of trade receivables will be recorded on the credit side. And in this case, the sales ledger control account showed a debit balance of 26,000. So this will act as the opening balance in this case. Now, for the first information, contra entries of 1800 in the sales ledger had been omitted from the control account. So we are yet to enter the contra of 1800 within our sales ledger control account. And remember that contra is something that will reduce both the trade receivables as well as the trade payables. So this will have to appear on the credit side within the sales ledger control account. So we need to enter 1800 here. Now, for the second one, discounts allowed of 3600 had been debited to the sales ledger control account. Remember that whenever there is discounts allowed, the value of trade receivables will decrease. So it was supposed to appear on the credit side, but we mistakenly recorded 3600 on the debit side. So we want 3600 on the credit side, but we previously have 3600 on the debit side. So in order to make this look like this, if we enter 3600 once, it will just get cancelled out with the previous incorrect amount on the debit side, but will not show the true value of 3600 on the credit side, which is why we need to record 3600 twice on the credit side. One so that it gets cancelled out with the previous incorrect amount, one so that it represents the correct amount on the correct side. So in total, we need to record 7200 on the credit side. Let's write that. Then the allowance for irrecoverable debts had been increased by 1200. Remember that within our sales ledger control account, we only include the irrecoverable debts, not the allowance for irrecoverable debts. So we can completely ignore this information. So we have 26,000 as our total. Now, the closing balance will just be 26,000 minus 1800 minus 7200, which results in 17,000. This is the correct figure for trade receivables at the end of the month, which is given in the second option. That is all for the 13th question. Let's move towards the next one. A business paid 5,750 during its trading year for advertising. This amount included 500 in respect of the next financial year. How would the correct treatment of the 500 affect the financial statements? Remember that this 500 is prepaid expense. So within profit for the year, prepaid expense should not be included because this is the expense for the next year, not the current year. So we will reduce this value from the expenses, and expenses will be subtracted while calculating the profit. So overall, this will increase the profit for the year, which is given by option C and D. And for the net current assets, remember that prepaid expense, we've already paid for it. Now we are yet to receive the services for it. So this will act as our current asset. So the current asset will increase by 500, which means that the net current asset, which is just the current asset minus current liability, will also increase by the same amount. So increase is given by B and D. Now the correct answer for both the profit for the year and the net current assets is given by option D. That is all for the 14th question. Let's move towards the next one. The books of a business showed the following balances at the end of the financial year on 31st December. We have trade receivables as well as the allowance for trade receivables. Then the following adjustments need to be made. How will the total of these adjustments be recorded in the statement of profit or loss for the year ended 31st December? Okay. An irrecoverable debt of 470, which was written off in the previous year, has been recovered. No entries for this have been made in the financial statements. So the previous irrecoverable debt has now been recovered, which means that this will act as our income. So within the statement of profit or loss, we now have income of 470. Then irrecoverable debts of 680 need to be written off. Irrecoverable debts will always be treated as our expense. So this will be subtracted within the statement of profit or loss as the expense. And remember, before calculating the allowance for irrecoverable debts, we also need to remove irrecoverable debts from the trade receivables. So we first need to subtract this 680 from the trade receivables. So the correct value of trade receivables will now be 18,140. And this allowance for irrecoverable debts is the opening balance. We need to calculate the closing balance now. The allowance for irrecoverable debts is to be 5% of trade receivables. So times 5%. This will result in the value of 907. Now, we also record the increase or decrease in allowance for irrecoverable debts within our statement of profit or loss. So we need to do that here as well. Our closing balance is 907, whereas the opening balance is 760. Clearly, there has been an increase. So this should be treated as part of our expenses. So the increase is by 907 minus 760, which results in the value of 147. So this should also be treated as an expense within our statement of profit or loss. So minus 147. So in total, we have 470 minus 680 minus 147, which results in minus 357. Since we have minus here, this means that this 357 is our expense. That is the answer we're looking for, which is given by option C. That is all for the 15th question. Let's move towards the next one. After preparing the financial statements of a sole trader, the following items were discovered. What is the effect on the profit for the year after correcting these items? Okay, for the first one, drawings consisted of goods taken for own use at the sales value of 12,000. The owner applies a markup of 50% on all goods sold. Remember that goods taken for own use will be subtracted within the cost of sales, and the cost of sales will again be subtracted while calculating the profit. So basically, the goods taken for own use will be added while calculating our profit. And whenever we record the value for goods taken for own use, we need to record its cost. But in this case, we've recorded the sales value. So we first need to calculate our cost. We have been given the markup of 50%. Whenever we apply markup, it will just be sales equals to cost times 1 plus markup. So the sales value given in this case is of 12,000. We need to calculate the cost, and the markup is 50%. So the cost in this case will be 12,000 divided by 1 plus 50%, which results in 8,000. So we should have added this 8,000 while calculating the profit, but we mistakenly added 12,000. Now we need to remove the extra 4,000. So firstly, the profit for the year will be decreased by 4,000 from the first information. And for the second one, profit for the year included an insurance expense of 7,500. 1/3 was for the owner's health insurance. Remember that owner's expenses should not be included within our statement of profit or loss. And in this case, 1/3 of this value belonged to the owner's health insurance. So that is 1/3 times 7,500, which results in 2,500. So 2,500 is the extra expenses that we have included. So expenses was overstated by 2,500. If something is overstated, we need to subtract this. And in this case, we're talking about expense, which will again be subtracted while calculating the profit. So we have two negatives, which results in a positive. In order to correct this error, we just need to add back 2,500 to our profit for the year. So overall, that will be negative 4,000 plus 2,500, which results in negative 1,500. So the effect on the profit for the year after correcting these items is that now it will further decrease by 1,500, which is given by option A. That is all for the 16th question. Let's move towards the next one. L&M are in partnership. Which item should appear in the partnership appropriation account? Okay, so within appropriation account, we start with profit for the year. We make adjustment for three items: the interest on capital, the interest on drawings, and salary. And then we get the residual profit. And in this case, interest on capital will be provided by the partnership business to the partners. So this will reduce the profit. Interest on drawings will be provided by the partners to the partnership business. So it will increase our profit. And salary is provided by the partnership to the partners. So this will again reduce our profit. So we have additional capital contributed by M. Capital contribution will not be recorded within the appropriation account, so this is incorrect. Cash drawings of L&M during the year. Remember that we only record the interest on drawings, not the entire drawings itself. So this will be incorrect. Then salary due to L. Remember that any salary to the partners will be recorded here, and L is a partner. So C will be our correct answer. Then we have salary paid to M's sister as well. Although we have salary here, remember that this is only the salary for the partners. And partners in this case is L and M, not M's sister. So this will already be included within our statement of profit or loss, not the partnership appropriation account. So D will also be incorrect. That is all for the 17th question. Let's move towards the next one. Valerie and Paul are in partnership, sharing profits and losses in the ratio of 5:3 respectively. The partnership profit for the year was 250,000. The appropriation account of the partnership for the year included the following information. We have total interest on partners' drawings and total interest on partners' capital contribution. What was Paul's share of the residual profit? Okay, we just need to prepare the appropriation account. I've already mentioned the format right here. So we start with profit for the year. In this case, that is 250,000. Then we have interest on partners' drawings. Remember that partners' drawings is paid by the partners to the partnership business, so this will increase our profit. Then we have interest on partners' capital contribution. So interest on capital is something that the partnerships provide to the partners, so this will reduce the profit. Now our residual profit will be 250,000 plus 12,000 minus 18,000, which results in 244,000. And in this case, we only need Paul's share of the residual profits. So for Paul, our profit and loss sharing ratio is 5:3 and 3 parts will belong to Paul. So that will be times 3 by 8, which results in the value of 91,500. That is our correct answer, which is given by option B. That's all for the 18th question. Let's move towards the next one. Which items will be shown in a company's statement of changes in equity? Okay, within the statement of changes in equity, we include any kind of share issue. So that will be bonus issue, rights issue, as well as new issue. We record all of our dividend payments. We record any transfer to the general reserve made from the retained earnings. We record any revaluation upwards or revaluation downwards. And we record profit for the year as well. So we need to look for those items. Now we have bonus issue of ordinary shares. That is true. It will be shown within the statement of changes in equity. We have issue of debentures. Remember that issue of debentures will make changes in our non-current liabilities, not the equity. So this will not be shown within the statement of changes in equity. Then we have a proposed dividend on ordinary shares. Remember that we only include the dividend paid, not the dividend proposed. So this is incorrect. Then we have an upwards revaluation of the company's non-current assets. Any revaluation upwards and downwards will also be shown within the statement of changes in equity. So our correct answer should include 1 and 4, which is given by option B. That is all for the 19th question. Let's move towards the next one. The table shows the company's equity. We have ordinary share, par value is 1. We have share premium as well as the revenue reserves. So revenue reserves just refer to all of our retained earnings and general reserve. Then changes now to be made to the equity in the order given are as follows. A 1-for-1 bonus issue of ordinary shares. So we're providing one bonus share for every one ordinary shares that we have. It means that we're basically increasing the ordinary share by the same amount of 200,000. And remember that bonus share will be funded by our own reserves. We first use the share premium account. So out of 200,000, 80,000 will be provided from share premium because that is the maximum amount available there. Then remaining 120,000 will be funded by the revenue reserves, basically from the retained earnings. So now after the bonus issue, the remaining revenue reserve will be 160,000 minus 120,000, which is 40,000. Then a rights issue of 100,000 ordinary shares of 1 each at 1.40 per share. So 1 is our par value that should be recorded within our ordinary shares. So 100,000 times 1 will be 100,000. Then we've issued this at 1.4, which means that 0.4 is our premium value. So the total premium value will now be 0.4 times 100,000, which results in 40,000. And all of the premium will be recorded within the share premium account. Okay, now the total ordinary share will be 200,000 plus 200,000 plus 100,000, which results in 500,000. Our share premium will be 40,000, and the revenue reserves will also be 40,000. Now, the company wishes to maintain reserves in the most flexible form. This means that for the bonus issue, we first fund using the share premium account and then we fund it using our revenue reserves. That is exactly what we've done here as well. Now, what will be the equity of the company? We've already calculated the value. That will be 500,000, 40,000, and 40,000. So we have 500,000, 40,000, and 40,000 within the first option. That's all for the 20th question. Let's move towards the next one. A company had the following balances at 31st December. We have inventory, trade receivables, allowance for irrecoverable debts, bank overdraft, and cash in hand. Current ratio is 2.5:1. What was the value of trade payables at 31st December? Remember that current ratio is just current asset divided by current liabilities, which in this case has the value of 2.5. So we just need to solve this equation and figure out the value of trade payables. But before that, let's take a look at these two values, the trade receivables and the allowance for irrecoverable debts. Remember that the allowance for irrecoverable debts should always be subtracted from the trade receivables at the closing date. And this is, all of the values are at closing date. So we need to subtract the 2,000. So the correct value for our trade receivables will now be 86,000. Okay. Now let's solve the equation. Inventory is current asset, so this will go on the numerator side. Then trade receivables is also current asset, so we need to record 86,000 there. Then we have bank overdraft, which is current liabilities, so 9,000. Then cash in hand is also current asset, so plus 5,000. Then we need to figure out the value for trade payables, which is also current liability. This should be equal to 2.5. So that will just be 31,000 plus 86,000 plus 5,000 divided by 2.5. It should be equal to 9,000 plus trade payables. So that will just be 48,800. This should be equal to 9,000 plus trade payables. So our trade payables should just be 48,800 minus 9,000, which results in 39,800. That is the answer we're looking for, which is given by option B. That is all for the 21st question. Let's move towards the next one. The table shows year-end information for a company. We have statement of profit or loss and the statement of financial position, profit for the year, finance cost, total assets, and total current liabilities. What is the return on capital employed? Okay, return on capital employed is just profit from operations divided by capital employed times 100. The first thing we need to do is calculate profit from operation. We can do that by utilizing our values from statement of profit or loss, because remember that profit from operation minus finance cost will be equal to profit for the year. And both of these values have been given. So profit from operation minus 12,000, which is our finance cost, will be equal to profit for the year of 55,200. So our profit from operations will just be 55,200 plus 12,000, which results in 67,200. Okay, now capital employed is just equity plus liability, and we can figure that out by utilizing these information. If we take a look at our accounting equation, that is just asset equals to capital plus liabilities. Capital will be our equity, and we can split the liabilities into non-current liabilities and current liabilities. So capital employed is this part. Now we have the value for assets as well as current liabilities. So asset is of 350,000. So the capital employed plus current liability is of 70,000. Now the capital employed will just be 350,000 minus 70,000, which results in the value of 280,000. So now the return on capital employed will just be 67,200 divided by 280,000 times 100, which results in the value of 24%. This is the answer we're looking for, which is given by option D. That's all for the 22nd question. Let's move towards the next one. A restaurant owner paid the following, which costs are indirect cost. Okay, cost of food ingredients. Remember that for a restaurant, the product will be the food items that they provide. And in order to prepare these food items, the food ingredients will be our direct material. So this will be part of our direct cost. Then we have maintenance of cooking appliances. Cooking appliances will directly be involved, but the maintenance of cooking appliances will now act as the indirect cost. So this will be included. Then we have wages to the chefs. Remember that chefs in this case are the direct workers who will work in order to prepare the food items. So this will act as our direct labor, which will not be part of the indirect cost. Then we have wages to the restaurant manager. Restaurant manager will act as the supervisor in this case. They will not be directly involved in preparing the food items, but they will be there to supervise the entire operation. So this will be included within the indirect cost. So the correct answer should include 2 and 4, which is given by option C. That is all for the 23rd question. Let's move towards the next one. Total costs for each of the 2 months had been recorded. Variable cost per unit remained constant. The total fixed cost increased by 1,000 in July. What was the total of the fixed cost in July? Okay, so for June, fixed cost is just fixed cost. For July, the total fixed cost is the fixed cost from the previous month plus 1,000. Now, in this case, we can prepare an equation because we haven't given the total cost, which is the sum of the total variable cost and the fixed cost. All right, so in this case, 76,000 is just the total variable cost. Total variable cost will just be the number of units times the variable cost per unit. And in this case, the variable cost per unit remained constant. So the number of units for June is 8,000 times variable cost plus fixed cost is just FC. Now we repeat the same process for July. For July, the value of 86,000 will be equal to number of units 10,000 times variable cost plus, now the fixed cost will be FC plus 1,000 because it is increased by 1,000. Now we can just subtract one equation from the other. So 76,000 minus 86,000, that's negative 10,000. 8,000 minus 10,000, that's negative 2,000 times variable cost. The fixed cost will get cancelled out. Then we have minus 1,000. So that will be negative 9,000 will be equal to negative 2,000 times variable cost. Now the variable cost will just be negative 9,000 divided by negative 2,000, which results in 4.5. Now we need to figure out the total of the fixed cost in July, this part. So we can just solve this equation again by inputting the value for variable cost. So 86,000 will be equal to 10,000. The variable cost is now 4.5 plus fixed cost plus 1,000. We need the total of this value. So fixed cost plus 1,000 will now be 86,000 minus 10,000 times 4.5. This results in the value of 41,000. This is the answer we're looking for, which is given by option C. That is all for the 24th question. Let's move towards the next part. P Limited uses an overhead absorption rate of 15 per machine hour based on budgeted machine hours of 8,000 per month. In July, production required 8,500 machine hours and the under absorption of overheads amounted to 16,500. What were the actual overheads in July? Okay, under absorption just means that our budgeted overheads was less than the actual overhead. We have under absorption of 16,500. So this is just actual overhead minus the budgeted overheads absorbed. We just need to solve the equation here. We are trying to figure out the actual overhead. Now the budgeted overheads absorbed will just be overhead absorption rate times the actual basis hours. So in this case, the basis hour is machine hour and we have the actual machine hours as well. And the overhead absorption rate is 15. So that will be 15 times 8,500. Now, the actual overhead will just be 16,500 plus 15 times 8,500, which results in the value of 144,000. This is the answer we're looking for, which is given by option D. That is all for the 25th question. Let's move towards the next one. Which statement describes the purpose of overhead allocation? So whenever we talk about the term allocation, in this case, we are assigning the specific cost. So clearly C and D will be incorrect, sharing out the common cost. And overhead allocation will be the assignment of specific costs to the production departments, not the service departments. So B will also be incorrect, which leaves us with option A. That is all for the 26th question. Let's move towards the next one. A manufacturing business provides the following budgeted annual information. Okay, we have the direct wages, 12 per labor hour, and the total is 600,000, and we have the fixed overheads. Now, fixed overheads are absorbed on the basis of direct labor hours. The first thing we can do in this case is figure out the total direct labor hours, because here 12 times the total direct labor hours will be equal to the total amount of 600,000. So the total direct labor hour will be 600,000 divided by 12, which results in 50,000 hours. And we have been told that fixed overheads are absorbed on the basis of direct labor hours. So we need to divide the fixed overheads by the total of our direct labor hours. So that will be 160,000 divided by 50,000, which results in 3.2 per direct labor hour. Then a job requires direct materials costing 480 and needs 30 labor hours. The business wishes to make a profit margin of 25% for this job. What is the price to be quoted for this job? We can first figure out the total cost for the job. So we first have our direct materials of 480. Then we have our direct labor. We have 30 labor hours and the cost per labor hour is 12. So that will be 30 times 12. Then we have our fixed overhead as well. And the fixed overhead is 3.2 per direct labor hour. For this job, we have 30 labor hours. So the fixed overhead will be 30 times 3.2. This results in the total cost to be 936. Now, in this case, we need the selling price, the price to be quoted for the job, and we have a profit margin of 25%. So, profit margin of 25% means that out of the selling price, 25% belongs to profit, whereas 75% belongs to cost. And sales will be 100% in this case. So, this cost value of 936 is 75% of the total sales value. So we can just utilize the unitary method. 75% is 936. We need 100%. So that will be 936 divided by 75% times 100%. That results in the value of 1248, which is the answer we're looking for, which is given by option B. That is all for the 27th question. Let's move towards the next one. Which factor would cause the variable cost line on a break-even chart not to be a straight line? So we assume the variable cost per unit will be constant no matter the level of the units. That is why the variable cost will look something like this. But for it not to be a straight line, we need to have a curve. And the curve will appear whenever there is a bulk discount, because as the number of unit increases, the value will slightly decrease due to the curve. So that's the answer we're looking for, which is given by option A in this case, bulk buying discounts from suppliers. Now let's take a look at the remaining option as well, employing an extra factory supervisor. So factory supervisor's cost will be included as part of our indirect cost, which will be included within our fixed cost. So this has no impact on the variable cost line. Then we have plant and machinery depreciation. Again, this is the same case. Depreciation will be constant, so we consider it to be our fixed cost. Then renting additional warehouse space. The total rental expense will also be considered to be the fixed cost. So these three will have no impact on the variable cost. That's all for the 28th question. Let's move towards the next one. The following information is available for a business. We have budgeted fixed cost per month, target profit per month, budget variable cost per unit, as well as the selling price per unit. Fixed costs are expected to increase by 500 per month. Okay, so we need to increase this by 500. The new fixed cost will now be 2,500. And variable costs are expected to increase by 5 per unit. So the variable cost will increase by 5, so the new variable cost will be 20. Which value of revenue will be required to achieve the target profit? Okay. And in this case, we have been given the selling price per unit. So in order to calculate the total revenue, we can just multiply the selling price per unit to the required number of units. So the first step would be to calculate the number of units in this case. So we can utilize our format for our marginal costing. We can start with the contribution per unit multiplied by the number of units. This will give us the total contribution minus the fixed cost will be equal to the profit. Okay, so now in this case, the contribution will just be selling price minus the variable cost, which is 40 minus 20, which results in 20. 20 times the number of units, and our variable and our fixed cost in this case is 2500. And this should be equal to the target profit of 3000. So now the number of units will just be 3000 plus 2500 divided by 20, which results in 275. Now for the total revenue, it will just be the number of units multiplied by the selling price per unit. So 275 times 40, which results in the value of 11,000. This is the answer we're looking for, which is given by option D. That is all for the 29th question. Let's move towards the next one. What are the assumptions of cost volume profit analysis? The first one is fixed cost per unit is constant. This is incorrect. We assume that the total fixed cost is constant. Then selling price per unit is constant. This is true. So sales volume is constant. So in this case, we are analyzing cost, volume, and profit. So we would definitely have to change the volume as well in order to get our impact on the cost as well as profit. So sales volume will not be constant. Then we have variable cost per unit is constant, which is true. So the correct answer should include 2 and 4, which is given by option D. That is all for the 30th question as well as the entire paper. If you found this video useful, make sure that you like the video and leave a comment below. And make sure that you are subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.